All right. So I'm here today with Chet Decker from the Mortgage Link. He is the VP of Residential Lending. So he is our go-to guy for any lending questions you might have during the home buying process. So one of the questions, Chet, that I get a lot is like, what loan options are available to me? You know, a common misconception is that you need 20% down to buy a home.
Right.
That's really not the case anymore.
Correct.
Buyers have options. So whether it's, you know, FHA, VA, conventional, down payment assistance programs, I kind of want to talk through what those options are for buyers so they can leave this with a better idea of what they need to do personally or what loan might work for them.
Sure.
So can you tell us the difference between the, let's say, most popular or most traditional financing methods, which would be conventional, FHA, VA, right? And what are the differences between those three programs?
All right. Well, there are multiple options for someone to buy a home, and it really is unique as the individual. We structure loans that meet their needs. So depending on the individual, it may make more sense for them to go VA, FHA, or conventional, which is your Fannie Mae, Freddie Mac loans.
And they don't necessarily need to know that when coming to you, right? Like,
correct.
Based on their qualifications, you're going to tell them what is the best program, right?
That is correct.
Okay.
So whenever I meet with a customer for the first time, you know, it's an exploratory conversation.
Right.
And I'm asking questions, I'm getting their questions answered. And as I'm getting answers to their questions, I'm already kind of thinking in my mind, okay, what is going to be the right product for this individual?
Right.
And I'll still go ahead and explain the others options. What I do in my job is I put the cards on the table.
Right.
I explain what the cards mean, and then they can pick the card that's right for them. And so FHA is typically your first-time homebuyer program.
Okay.
Doesn't have to be.
And why is that?
Because of the qualification parameters. So the differences between Fannie Mae, Freddie Mac, your conventional loans, and your government loans, which is FHA, VA, USDA, is the guidelines, the rules that they have.
And that's kind of what their profile is to qualify for these different programs,
correct,
right? Okay.
Correct. So if your credit scores are lower, FHA makes more sense.
And what does lower mean?
So anything below 700, 720 is not really appropriate for a conventional loan. The conventional model of home loans, they're looking for credit scores that are really 720 and above, and people with low debt to income ratio.
Okay.
There are two key factors when qualifying for a home loan.
Okay. What are those factors?
They're both equally important. The first is the credit score.
Okay.
It's got to be above a certain number.
So we want it above 700 for conventional. And if it's below 700, we lean towards more
FHA.
Okay.
And
those
then
government
FHA makes more sense. They're not as penalizing on the credit scores as conventional is going to be. Conventional makes it very expensive.
Okay.
If your scores are below 700, they're going to hit you in what's called the interest rate and what's called the mortgage insurance. And they're going to be more strict and more expensive for lower credit scores.
Right. So they could qualify for conventional, but long term it might not be in their best interest.
Correct.
Which is why, you know, somebody's newly building their credit, you know, they might be better apt towards FHA or government.
A great way of doing it when you're buying your first home is start with that FHA loan. Within a couple of years, you're going to have enough equity capture in that home because the home's going to continue to go up in value as you live there, and your balance on your mortgage is going to continue to go down as you make payments. So typically within 18 to 24 months in the DFW market, even if somebody put 3.5% down on an FHA loan, they're at 2 years in going to have enough equity to refinance to a conventional loan. And the nice thing about a refinance is you're able to roll in the costs into the new loan. You're not coming out of pocket, maybe for the appraisal, and you typically bring no money to the closing table, and you skip 2 months house payments. So you can go from FHA to conventional once you've been in the house. Just having a home loan is going to help your credit scores increase.
Because that's consistent monthly payments that'll help you build your credit.
That is correct.
Right.
And a mortgage makes up 35% of your credit score.
Okay.
So getting in there, getting your foot in the door, getting the house, that's the key to start building your financial future. And then you can use that house to your advantage down the road to not only improve your score, but lower your interest rate, get over to a conventional loan, and get rid of mortgage insurance, things like that.
Right.
Because FHA does have mortgage insurance, whereas on conventional, once you're below a certain amount,
Right.
you no longer have that
Well,
mortgage
that's where
insurance.
the idea of 20% comes from, right?
Yes.
Because when you have the 20% equity in your home, whether that's over time or from your down payment, that's when the mortgage insurance goes away on a conventional, right?
That's correct. Well, it's actually a federal mortgage guideline requirement that every bank and lender in the country must follow. If you are putting down less than 20% on a purchase of a home, or the loan to value of the home, that's how much the loan is versus how much the home appraises for, loan to value. If that exceeds 80% of the value, the loan exceeds 80% of the value, mortgage insurance is required.
It's a requirement.
You're
right.
not getting around it. Now, what I don't like about FHA for first-time home buyers is if you put down the minimum of 3.5%, the mortgage insurance is going to be permanent for the life
of the loan.
Yeah.
Correct.
If you keep that loan for 30 years, you're going to have mortgage insurance for 30 years.
Whereas on conventional, it falls off.
Falls off.
Right.
It does. It goes away.
Okay, so we were talking earlier, the two things that people kind of need to consider when they're, qualifying for a loan, and it was their credit score, which we talked about a little bit, and the other part was the debt to income.
That's correct.
So can you tell us how that debt to income is calculated? Because I think there's some misconceptions there about, how much their debt is versus, I think it's going to be their monthly payments, right?
Exactly.
So can you tell us a little bit about that debt to income and how it plays into their qualification process?
Yes, ma'am. Absolutely. So the debt to income ratio, that's how much money you've got coming in the door from your job. And that's calculated on your gross monthly income, not your take-home pay, not what you're left over with, but your gross pay before any taxes, deductions, insurance is taken out. So, the big number we all wish we made.
Right.
So that's
the
money.
Fun number,
yeah,
right?
Exactly. That's,
very deceiving
yes,
number.
Ma'am. That's what you got coming in the door. Well, your debt to income ratio are the debts that appear on the credit report, student loans, credit cards, auto loans, all that stuff. Any child support that you may have, any debt obligations that you have, that gets factored in. And then the house payment gets factored on top of it. And that's going to make an overall percentage ratio of your income. And to qualify for a mortgage, that's got to be below a certain number or you don't qualify. So your credit score's got to be above a number, your debt to income ratio's got to be below a number, or you don't get the loan. Doesn't matter how much you're putting down. If those two key factors aren't there, you don't get the loan.
And my understanding is that FHA and VA has some more flexibility in terms of you can have higher debt to income ratios versus conventional. Is that correct?
Correct. Okay. Most conventional loan programs, if your scores are in the low 700s and you're putting the minimum down 3 to 5%, then you're going to be capped at a 45% debt to income ratio.
Okay, and that's including the house payment.
Yes.
Interest or insurance, all of it.
Principal, interest, taxes, insurance, any HOA dues that property may have, any additional mud puds or PIDs that are over and above the taxes that property may have, all of that's factored into your monthly mortgage housing expense.
Right.
And that's what makes up the debt to income ratio plus the debts that are on the credit report.
So if people are wanting to figure out, how much can I afford monthly? We've got to back them into that debt to income ratio. How much are your outgoing expenditures and debt payments plus where you want your target mortgage payment to be?
That is correct, yes.
Okay, perfect. Now you mentioned something when we were talking there and you said 3 to 5%. And I know what that 3 to 5% difference is for conventional. Yeah. Can you tell them why there is a discrepancy there, or what the difference is between, do you need 3% or 5% for conventional?
So conventional, they do give you the option of putting 3% down. It was originally for first-time home buyers, but they
changed that. To help people
get
into homes.
Correct. They changed that to where if you qualified for it, you could do the 3% down. Now, if you're a first-time home buyer on the 3% down conventional programs, you do, if you're below the area median income, which again, the lender will look up for you. We have a website for that.
All these things he knows that we don't have to pay attention to.
Don't want to get too deep
into
the weeds.
Understand.
But if they make below the area median income for where they're buying that home, then they, as a first-time home buyer, can put down 3% and they will pay a reduced mortgage insurance and they have a reduced interest rate. So just slightly below market. It's not astronomically better, but it is better.
Right.
So if you can qualify for a conventional loan from the get-go, that's usually the direction I try to take somebody from the start. But if for some reason conventional is a closed door, well, FHA is the backup plan.
Okay.
Because owning a home is far more beneficial to the individual than renting.
Right.
You know, when you rent, you're lucky if you get your security deposit back.
Right.
When you own a home, if you maintain it, you get every penny you put back into it and then some.
Mm-hmm.
That's why owning a home is so important for your financial future.
Right. All right. Well, I think that takes us to the end of that topic on FHA, conventional VA. But if you have any questions, feel free to give us a call. Thank you so much.